for our first session, it's one of our more popular sessions, of course. It's to discuss the state of the market and kind of give us a little information about fit. But Peter, if you don't mind introducing our next speaker.
You bet. So for everyone who's been here for previous years, you all know Shane, but a little bit of bio about him. Prior to starting Ballator and Nonprofit Insurance Services in 2007, he was with a nationally traded broker, and but on a personal note, he is all of our boss. Obviously, we love him anyway, and everybody loves his session, so.
Boop.
Here's your clicker.
I got the clicker, we're in trouble. As everybody you're going to see, we're really, really glad to have all you. You're going to hear that from every speaker that, I mean it from my heart. We did this virtually last year. I think we pulled it off okay, but it's really the interaction and the drinking later that really everybody, with that being said, we appreciate it very much that our clients and agents and carrier partners have showed up because we all put a lot of work in this. It's not just us. NPIS is we're the ones that get up here and put on the presentation, but it's really the members, the agents, the carrier partners that really make this thing go, and we don't ever want to lose sight of that. So what I want to do is take a few minutes to talk about just really three things. One is the state of the insurance market. Now, this is nothing to do specifically with fit. So as I'm going through it and I'm showing you some of these percentages, don't get freaked out because our part is what's fit going to do this coming year. But I do think it's important to put in connotation, what's happening in the general market. And it's hard for, those of us in the business, we get emails and text each and every day about something new where I don't think the general, not-for-profit gets them. So I do have to put a little preface on this because out of this group, and I've been looking around to see, we have two different groups. This is our 14th actual conference. Well, it's the 14th year, or it's the 12th conference. Last year was canceled due to COVID, and 3 or 4 years previous to that, we actually were all here and a hurricane came through, so we didn't get to do it. So it's our 14th year, it's our 12th conference. So obviously I'm dealing with some folks that have been here, for all 14 years. And so some of this may be a little bit boring for you. In fact, I had one of our esteemed agents tell me that if I put up the timeline of pooling again, that he was going to beat me up. I'm not going to say who it was, but I bet most of the people in the room can figure it out. So I found out a way to present it in a different format, buddy. Okay, just a little bit of a theme, It's the same year, the same hurdles. I mean, when we did it virtually last year, we didn't get to stand here together. But if you really think about it, I mean, yes, the economy's starting to move. The insurance market is starting to come back. But if you look at it, I mean, I didn't put these up last year, but we're still dealing with, masks, whether they're mandated or not. Everybody wants to work remote now, so nobody wants to come to work. And we still had a very active hurricane year, which obviously affects us all in Florida. So, I mean, yeah, a lot of this stuff is going to sound a little redundant, but if you really think what's happened, we're sort of stuck in a holding pattern right now. Vote's always going to be controversial. I try and throw in a fun little fact so that whoever the agent was, so I can cover the same crap without putting up a line item. But a fun fact, the Versa Insurance Company was signed in 1347 in Genoa, Italy. The point that I've always put that timeline up was we could talk about insurance companies and different types of insurance companies, but the very first insurance, going back to 3000 BC, was all pooling. So, and that's for the benefit of the newer members to understand, this has got multi-thousand years, much longer than commercial insurance company. In fact, that's probably the first commercial insurance company written over there. I'll talk about some of the stuff in the States. Okay, an overall state of the market. Combined cat losses continue to loss creep up. We think it is, and our industry reports how much we lost, and then over time, demand surge, it typically goes up. So, I mean, I'll go through it quickly though. 17-18 was the worst year of all time at 115 billion. And then you get to 18 and went to 80 billion, 19, 55 billion, and then 20 at 958 billion. And the reason that's important to you is we're obviously all in a cat-prone state. And these losses are worldwide. They're not just the United States, but it's important for everybody to understand that the same people that are reinsuring FIT reinsure, tropical cyclones, earthquakes. So at the big top, there's just one big pool of money. It's all managed, and what the money managers try and do is invest it because this is going to be paid out over time. So these amounts of losses aren't going to be paid out on one day. So I mean, that's where insurance makes most of its money, collecting premium. Most of the industry runs above 100 combined, but they give it back slowly and they make some income on it. Obviously, there's not a ton of investment income to be made out there, which is why we've seen, particularly in the catastrophe-prone areas, those losses starting to creep up, and thus the prices. Treaty reinsurance. Reinsurance is just insurance companies and pools like us. We buy insurance just like anybody else. If you go back to June of 19, we were looking at 25% increases, and then we got to January of 20, it had slowed down to 5 to 10, and this is still a little bit dated, but we're still in that 5 to 20 range. So that's how us, as your insurance carrier, we have to deal with that because we know that your organizations can't support those kind of rapid increases. So when I get to the FIT part, we'll talk about the stuff we're doing to kind of have these things go down. But these are real numbers. Our trustees see them when we present them to them, and sometimes they get sticker shock too because the excess coverages are actually going up a lot more than the primary coverages that most of y'all buy. And then COVID-19, I tried my best not to include anything in COVID on this one because we're all tired of talking about it, but it is still having an impact. So there's a couple points, I just got to point some stuff out. But when COVID first happened in 2020, the industry lost its mind, and they thought it was at least a $30 billion to $100 billion event, when in reality, it's closer to 6 to 12 billion. Now, they're still going to throw that in with the cat number, so you'll see that those cat numbers, knowing that their bogey's about 100 billion, the insurance market can pay out about 100 billion in cat claims before it's just lost its profit. After that, it starts to erode their capital, which is what they really don't want to have happen. A couple updates on timing, and it isn't always appropriate to look at stuff on a quarterly basis, but the insurance market has been changing on a quarterly basis. So, I mean, early January 2021, we were looking at 8 to 20% increases. If we have loss challenge account, that means you have multiple losses. You're looking at 20 plus, which is very scary. People didn't realize how big the Texas ice storm was. It was bigger than most of the hurricanes as far as loss valuation. And capacities are there, but the carriers are being very, very picky, and obviously that's one of our jobs is to make sure as a whole group that we're an attractive looking group so that we can get the best reinsurance, which comes down field to y'all. And the reinsurance market overall is stable. Has anybody ever noticed, I'm going back through my memory, and I don't think that there's ever been a cool TV show or movie regarding the insurance industry. No, I'm serious. Can somebody, I remember the one with Pierce Brosnan where he was like an art thief and some other famous, but which one was that? Renee Russo was her, and it's like a romantic comedy. But guys, we own commercials. Geico, you can go right down the thing. Limu, you're a crazy man. So when you get to mid-March through May, the markets were actually going up at that point, 10, 20%. Then London stepped in, as often happens. London's got a capacity, and luckily that brought it back down to ground a little bit. So, we're seeing renewal pricing in the 7.5 to 15% increases. But the cost of our reinsurance is still going up at a faster clip than that. All right. GL is general liability, POL is professional liability, and this is a real problem for us, and it's a real problem for most of y'all this time. The rates are really continuing to go up. Sexual abuse liability is a huge concern, and we've seen the claims. We have a lot of these from different types of entities, but they're getting more prolific. Social inflation continues to impact claims as well as pricing and capacity. And I think what everybody knows what social inflation is, it's those inflationary that's caused by the, I want to call the new normal of people thinking. There's a lot of folks that look at entitlements. You're seeing much higher jury awards than you would have, say, 10 years ago. And so that's really hard to measure. The recent renewals on, this is just the GLPOL, are looking at 10 to 25, with the reality being closer to 20 to 25, and the losses are actually there to support it. So I mean, we got to do some stuff to try and help you guys not have those claims. We've already done it, but we had our board meeting this morning, and this was a big part of the conversation. What can we do to cut down on these claims? Auto's getting better. The last 3 years, auto's seen 10% increases each of the last 3 years. We really thought, all of us thought, that COVID, with all the bad that it's doing, it's going to help auto. And sure enough, the frequency numbers went way down. So COVID, okay, when we're looking at the number of times we have a loss, that has gone down with fewer people on the streets. But the problem is the severity went up, and I don't know if that's if you're the only car on the street, you tend to drive faster or more reckless, but the numbers, and this isn't just for us, this is industry-wide. The year that we were shut down for COVID, the losses for auto, luckily they didn't go up, but they pretty much stayed flat, which was really surprising to myself and most people in the industries. The key driver continues to be the same thing it has been. It's the distracted driving, which we all know nobody, all of us that have kids, they never text in the car. And increased cost of vehicles. It's great we have all these safety features, but a fender bender used to be $1,500, and now it's $5,500 because you got to replace the sensors and all the other stuff. And the recent renewals have been between 7.5 and 15%, 10 probably being the average, which would be exactly what it did the last 3 years. And social inflation, of course, I had just mentioned. Okay, work comp. There's a little bit of misunderstanding what's going on with work comp. The Florida OIR, that's Office of Insurance Regulation, approved a 5% rate reduction effective January 1. So sounds good. The problem is people don't understand there are hundreds and hundreds of class codes, and that's the exposures that we have. And I don't know the total number of classes, but it's somewhere around 20. What would you guess, Peter? About 20. And on those 20 classes that represent this group here, we saw about a 1% average increase. So when you look at the codes, some were down more than 5, some were up more than 5, but I mean, we were luckily right in the middle at plus 1%, which means we're probably pricing adequately based on the OIR. Impact of COVID is still being assessed. We got, and I think all the carriers got, a ton of claims, thousands and thousands. We handled them just as the Office of Insurance Regulation advised us to do, just by the same old rules that we did. If we can confirm it was work-related, we've paid a bunch of these. Now, luckily, the ones that we paid haven't been high, so it really hasn't hurt us, but it looked really scary when all of a sudden you get in thousands and thousands of COVID claims. Now, we probably paid more than most because we have, as you guys all know as a group, we've got first responders. And those were the groups that it's state specific, but most of the states said, look, if it's a first responder and they end up with COVID, you're stuck with it. So we indeed have to work through those waters. Our excess work comp rates are still seeing 10 to 25%. As I had mentioned, that's kind of our job, is to make sure that's mediated before it gets to you. And, as I had mentioned before, COVID really didn't impact payroll as expected. I think that's unique to this group because we run some other mechanisms that are similar, and the payrolls did go down. But for this group, once we did the audits, a lot of the people's payroll actually went up, which was kind of surprising to us. Cyber, scary, scary cyber. The cyber criminals are targeting organizations that have sensitive information, which is this group. Insurance companies are restricting coverage and limits. There's not a day goes by that I'm sure everybody in here reads about another cyber attack. And I mean, if they can attack, the National Security Agency and the Federal Aviation Administration, they can hack our organizations. I'm sure, just like we are, we're all doing what we can, but it's evolving so fast that it's almost impossible to keep up with it. And there's been so many big hits that the insurance companies are taking the approach. There's a few that are getting in it, but most of them are just saying, hey, I'm just gonna stay away from this until it plays out and we know how big it could be. Because I think everybody's heard of, $100 million ransomwares that actually got paid. Aggregate limits in particular are being reduced, deductibles are going up, and premiums are increasing more than the other lines of coverage, and it really comes down to how much coverage you can buy. Okay, here's the COVID. I had to throw it in obligatory. I'll go through it quickly because we're all tired of hearing about COVID. But, the property, the business interruption did not have as big of an effect as we thought. Work comp varied by state, although Florida turned out very good with some court decisions. Liability was another big concern. Florida did pass legislation that gave partial immunities to business. We do business all over the country. I can tell you with the COVID stuff, you don't want to be doing business in California because they essentially just open the doors and says, if you've got a COVID case, it's going to be covered. And the industry got stung out in some of those western states. And then the auto, again, I mentioned the frequency's down, but the severity's up, so the annual losses ended up being about the same thing. All right, so that's kind of the insurance industry. Rather than wait to the very end, does anybody have any questions about what's happening in the insurance industry? I'll always go back at the end and see if you have any other thoughts, but while we're on that part, I'll figure out how to ask. Man, I must be doing good. Oops, I can't go backwards. Michelle, can you go backwards one? All right, just a fun fact. FIT started in 2007, and technically in June 1, 2007, and a year later we had our first conference, which is this conference, and we had 15 members attend, and then every subsequent one we've had more and more and more and more. We hope to be doing this for a very, very long time, and for those numbers to keep going up. All right, here's some of the stuff that for you that have been here for 14 years will be a little bit boring. But who can pull for insurance? If you look at these types of organizations, governments, public utilities, housing authorities, independent education, electric cooperatives, and nonprofits, they're all either government funded or semi-government funded. This is something that government gives itself to keep its costs down. I mean, that was the whole purpose. They all got into statute individually, with our part, nonprofit organizations being the most recent. All those other ones, government goes back to 1967 or 68. But of course, we just got the legislature to pass this law that allowed this organization to be back in 2007. All right, here's some more facts that the newer folks need to know about us. There's the Florida statute, 6244625. It's not the most interesting reading, but it really did help this group. It's governed by a board of directors who are FIT members. Our board of directors has to be members of FIT, therefore it's self-governing. We do submit financials and actuarial to the Office of Insurance Regulation, so a lot of people want to know, well, how's this thing regulated? We're regulated essentially the exact same way that an insurance company is. We have to give them a financial statement. We have to give them audited financials. We have to purchase excess insurance from authorized carriers. So that's the state's way of just trying to make sure we have enough back-end protection to meet our front-end obligations. And the majority of risk, specifically the catastrophic risk, is transferred to A-rated carriers. When I start talking about our property program in a little bit, we'll show how much we've paid, and it's particularly been structured to make sure that the trust does not retain any risk. It's all transferred to insurance companies. as we started, I thanked some folks. Like I said, we're kind of the face of this thing, but there's a lot of people that work to make this thing successful. Shores, Tagman, Butler and Company, that's the top pooling accounting firm in the country. They do the accounting for roughly 125 pools. Same thing with Casualty Actuary Consultants out of Nashville. All they do are pooling and alternative funding. So, I mean, we've tried to team up with the absolute best of breed. Of course, administration backs us, but if you'll notice, we're one of 6. Legal, Jack Brennan, all he does is insurance law. He's based out of Tallahassee. And then claims administration and loss control, that's Sedgwick out of Boca. So while we're dealing with a national organization, we're dealing with the local office that we've been with since the start of the program 14 years ago. One of the things we changed this year, in the opening, I thanked the agents. Obviously, there's a whole lot more of you than there are us, and we've got to be able to touch you and make sure you get the services you need. And the way that we decided to do that is through the agency distribution system. We have, and I won't go through the whole thing, but essentially, we want to stay close to what's going on. We can't sit up in, some kind of a castle and not know that you're being delivered X% of increase and that we can't do anything about it. So we need people to interact with you guys. Most of our folks are very, very good about it with, we all probably oversee more than you would want, but we'd rather overservice than underservice. And so really the goal is to continually provide us feedback on, hey, do we still have the best property coverage in the market? Or, hey, the market's going down 12%, we got to find a way to change the pricing. And then here's the guys, we do it with a limited number, which is very unusual for insurance, because for the most part, insurance companies do business with essentially any licensed agent. We decided to go a different route because there is such a specialty both in this nonprofit social service sector as well as dealing with pooling. We want to make sure that guys, when they sit down with you, they can show you this is insurance, this is pooling insurance, and they know all the details. And I think all these guys are here, but Eric Beck, Jerry Fiacco, who threatened me, Jonathan Rivera, Dave Pilkington, Terry Cooper, Steve Light, Mike Shea, Ricky Bouchard, John Ulrich, Eric Parker, and Doug Childers. I was going to have them all stand, but it's a pretty good number, and I think most all of them are here. They really like to come to these things to stay close to y'all, to know what your heads are thinking. But to us, I mean, this is our dream team. We handpicked these guys over multi-years, and, they do a very good job for us, and I know that you think they do a very good job for y'all. Okay, one of the questions that always comes to pass, because over the 14 years, the number's grown every year, but we've averaged over 98% retention. And the question is, well, how do you do it year after year? And insurance companies don't seem to do it. They seem to come in the market, jack up the price, get out of the market. Well, it's just a couple things. One is focus. I mean, when all you do is one thing, you got to find a way to be better than the next guy. So, I mean, part of it's focus, but part of it is just actually built-in advantages that we have from pooling. So the red box is how an insurance company prices for your product. You'll notice that the blue box up on the top one and the red box, those are the same number, 66.5. But when you look at the other boxes, and a very obvious one, this is where I wish I had a pointer, but the pink box on the middle of the bottom, taxes are 5%. That's just the state rule. So that's what the insurance companies have to pay the state, premium taxes. Well, if you look up at the FIT, it's 1.6. We gained 3.4% simply on the state charges us less in taxes. And then if you look at the, not to beleaguer them, but if you look at the rest of the boxes, up in that top, the yellow savings, we have a built-in 14% advantage over an insurance company. That's not us doing anything fancy. That's not us doing great underwriting. That's structural on what we are designated by the state of Florida. And everybody knows, I think everybody knows I'm a big Benjamin Franklin fan, so he brought the first insurance company into America, and Jerry, you're going to have to bear with me. But it was really funny. I told this last year. People thought it was funny. He started the first fire insurance company, but the fire insurance company wasn't insurance like we think of it. If you paid him a premium, you would get a sign, and you put the sign in front of your house or your building. And if it caught fire, the fire engine would come put it out. But if you didn't have the sign, you're not getting your fire put out. So, I mean, it is kind of insurance, but, you know, not so much. You just, I don't know what took you from stealing a neighbor's sign. Okay, so here's an overview of how we've turned out over the past year. It's been a challenging year. It doesn't look that different from last year. We've gained a lot. Member contributions went up from 44 to 56 million. Member contributions, we can just substitute premium. Technically for us, because we're a pool that's member contributions, if we were an insurance company, that would just be premium. Of that, we spend almost 22 million on us buying insurance. The losses, those almost 21 million. So in this particular year, we paid out 21 million in claims. The underwriting expenses are all the other expenses that we just looked at that big round graph that we had, and that's 13.6. Now here's the part that hurts us, it hurts insurance companies. Net investment income, which again I had referenced, that's where most of insurance companies' profit over all the years come from. And of course, we were almost zero. 2 years ago, it cranked up to about 2%. And, you know, this past year, it's back down to zero. So if I go 1 year back, we gained some 323,000 roughish in income. And that is not a typo. That's not a thousands. This past year, we made $12,726 bucks. So it gives us a bottom line net income of 325,000. You know, our stated goal as a pool is to add between 50 and 500,000 in surplus every year. The last 2 years, because of investment income, we were north of 500,000, which is really the top of our range. This one, you know, we're still off the bottom of our range. Would still really like to get some of that investment income back. And the balance sheet, the strength of any financial organization. Again, we're regulated by the state, so there's not a lot of fancy stuff we can do. I mean, we have 30 million of cash and cash equivalents. The total assets are 60, with the vast majority of that being in payments that insurance companies still owe us back. So we're always paying out on your behalf and collecting back from the excess insurance companies. The expenses were 55 million, and then that gives us a total fund balance of $3.2 million, which if you were an insurance company, you would call it surplus. And a lot of times people will speak to you and talk about, well, they don't have a lot of surplus. Well, one, by definition, if we have a lot of surplus, we're overcharging you. And surplus, just as it's defined, is surplus. They don't realize that we don't use that to pay claims. There is millions and millions and millions of dollars set aside to pay claims on all the reserves. These are numbers that we need them as a safety net, but we don't want that to get too big. As a matter of fact, if a pool, which we have several pools that have done this, that number gets to be large, the members start coming back and say, no, you don't need that money. Let's reduce this thing down. We like it to grow. That way we can mitigate the increases. If we have a particular year that our cost of insurance just goes through the roof, that extra money we can have there and come to you. And we actually did this 2 years ago. 2 years ago, we didn't come to you and say, I'm giving you the money back physically. But when we calculated the renewal premiums, we are like, well, we needed 16%, but our insurance can't pay 16%, so we're going to use some of this to keep it down to 11%. And this is just a bar chart of our growth from 08-09, and you can see we hadn't blown up the world, but it's been consistent growth. And the same thing on the written premium. You can see it's almost the same level. You can see these last 2 or 3 years where the reinsurance cost went up, where the growth in the premium was a little bit higher percentage-wise than the growth in members, but we've grown consistently in both in members and written premium, and we always want to keep this as a track just for a point of reference. The bottom there, we have paid since 2007 over 200 million in total claims paid and processed, and we've gone through 14 hurricane seasons, and out of 14, I'm not sure how many we got hit, but I can think of 6 or 7 off my mind. And the point of that is that's something that everybody always asks, who's going to pay the big claims? I'll show you who is, but the total hurricane claims out of that 200 were just north of 50 million. Here's the guys that pay the claims. We do have an operating layer that we pay, but we use some of the most prestigious reinsurers and excess insurers in the world. Some of these you'll recognize the name, the rest of us in insurance, but you got Britt that provides our work comp, Markel and Britt does that GLPL auto, Ameritrust, which we have Fred from Ameritrust in the audience. Thank you for coming, Fred. They really saved our keister, saved all of us some money last year. Markel and Britt do the D&O and the EPLI, and then Lloyd's is the lead on our property, but here's how we keep the thing consistent for y'all. We call this the mud map. So here's the structure of the problem, and you can equate it to a duck. You know, we give you one policy that has limits and guarantees to pay and deductibles. Behind the scenes, this is all the stuff and of particular interest, you may not be able to read it, but this Lloyd's, there's 26 other carriers in that layer. So when we do take a big hit, and we do, we don't take any one carrier and just crush it. We intentionally structure it where a big hit is mitigated, and therefore we don't get as big an increase. And therefore we don't have to pass along that big increase to you. But I mean, you can see the names of the carriers, and it's pretty traditionally stacked. It's really not that fancy, but I'm sure not everybody realized that behind the scenes, there's some 32 or 33 carriers providing the ultimate coverage. Here's our property program app. We're very proud of our property program. Number one, we have as low as 2% deductibles. I don't think there's anybody else in the state that has 2%. We still have the Tri-County area that we're at 5, but the rest of the state we're at 3. And 3 I still think is much better than what's out there. So one of our goals is to keep these percentage wind deductibles down to a minimum. We've been able to. And then some of the sublimits, this class of business really shouldn't have this coverage form. Our claim to fame is actually providing governmental pools around the country. And so we have a proprietary public entity form. Public entity property is typically a lot better, but we got the carriers to agree we're going to use the same form for all of our pools, and therefore we ended up with this. And most of y'all prior to joining FIT didn't have any business interruption. We saw from the hurricanes we paid out a lot in business interruption. A really important one that we keep waiting. If the market gets hard, we're going to have to sit down and have some hard conversations with these carriers. But we have $10 million in miscellaneous unnamed locations. And it is just what it seems. I think I know most of your property schedules. And by the way, you guys get gifted stuff and stuff for tax transactions. I can almost assure you every organization has property they don't know about. So what do you do when you got property and it goes away but you didn't realize it was there, or at least you didn't schedule it on your insurance? This gives you a $10 million bogey. I always ask everybody, please don't take advantage of it. It's meant to be a bogey. You can't just take your $10 million schedules off. We actually had a real world. One of the Goodwills, who I believe is here tonight, couldn't believe it when he lost a building that he didn't schedule and didn't pay any premium on, and we paid for it. So we've got some real world. I'm sure over cocktails tonight we'll talk about some of that stuff. Okay, property modeling. Not a super exciting function, but to put stuff in perspectives, the whole insurance industry is based off of modeling. And it seems like they're pretty close. We've been doing it for 20 years now. And air modeling is the one that most insurance carriers use. So to put stuff in perspective for you, this is the FIT air model. And it's just, so at the bottom, so a 100-year return is not that you're only going to have a hurricane every 100 years. It's that you got a 1% of a hurricane hitting. So you can have 3 years in a row with it. It's really just the fact that you got a 1% chance. So that 100-year, all of the takeout insurance companies that are sponsored by the state, American Family, I'm trying to get through, there's like 60 of them. The state makes them buy to the 100-year event, which in our case would have been 41 million. The 250-year event is kind of the gold standard for A-rated insurance companies with the state. So the insurance companies that you guys know, State Farm, Mutual, Allstate, typically they're going to buy to the 250. We're being very, very conservative. If you'll notice, the 1,000-year event, which is for us, it's the 0.01%, not 1%, 0.01% that it would happen, is 111 million, and you'll see at the bottom that we're currently purchasing 150. And the reason that we're doing that is we continually look at this quarter by quarter, and we're growing. We would rather be more conservative as far as having the coverages than less conservative. And again, we have to build in for some growth. Some new resources that we brought in. I mean, every year we want to be able to stand up here in front of you and say, hey, this is what we've done to move the ball for you. NPIS and Ballator joined an international broker. And what that means to you is two things. One, you're not going to see any new bodies. We're going to do the same thing. We'll be here next year and it'll be the same people presenting. But we, as an organization, have a whole wealth of new resources to support us, our people, and all of y'all. We got a new internal trust actuary. If you'll remember a few slides back, part of the requirement that we have to file with the state is an independent actuarial statement. The inner workings throughout the year, this is the person who does all of the loss analysis for us. We also ended up with the new internal trust accountant. Trust accounting is a little bit different than GAAP accounting. There's some nuances to it, and there's not that many people that do it. So we were very blessed to get one of the best in the country. So we brought her in as soon as we got the opportunity. We put in a liability litigation manager, handling all those claims, the $50 million a year of claims that are paid. The majority of those are larger liability claims. So we actually took our best attorney and said, look, you're going to manage this stuff for us because we can't afford to have adverse claims experience. And then the Claims Administration Services, RFP means request for proposals, meaning it's prudent for us, just like it's prudent for y'all, every so often to look at alternatives for insurance. It's healthy. This is our claims administrator. Claims has been very difficult since COVID. It's hard to get people to work. So we wanted to make sure we still had the best service as well as, you know, the best priced product out there for our members, because ultimately we all share in this cost. So we did go through that process, and in fact the process is still going on. A couple of the things, we always try not to toot our horn in this, but NPIS was named the Wholesale Broker of the Year by Business Insurance Magazine, which is a pretty big deal for our group and this group of young men and women. FIT became the largest pool for nonprofits in the nation. In fact, I think it's by a good bit, and we're getting close to being in the top 10 of all pools in the nation. We've given back $400,000 for the benefit of memberships and partnering associations. I think most of you folks are part of the associations that we sponsor. We'll usually see you out at, I can guarantee if it involves food and liquor, my group will be there. And one thing we pride ourselves on, I mean, I'm not going to say we could always do this, but for 14 years, we've had no non-renewals due to claims history. Now, we've had some organizations that we really had to work with, that we had to sit down and spend a lot of time saying, look, we really want you in, but you got to help us with this. But we haven't, and I guarantee you, everybody in here at one time or another has been non-renewed by an insurance company. I mean, that's just, I do it on my personal property all the time. Thank y'all. Does any questions?